Welcome back, happy investor, to a new update of my investment portfolio. As you know, the monthly update is here again, and my DEGIRO investment portfolio is almost reaching 200,000 done. My other account, Interactive Brokers, is also doing quite well, and both performed significantly better than the S&P 500 and also the Nasdaq 100 last month, where, of course, AI has dropped significantly based on news from China. And I already mentioned 2 weeks ago, listen, I'm buying more now, and specifically in China, what internet stocks and why. I also showed that in another video. We're going to dive into that again to explore what the opportunities are. I've also explained my strategy several times before, reducing exposure to the high valuations in America, more towards the lower valuations in Europe, and a bit in Asia, or that it's the best investment strategy. I wouldn't know. Focus. My goal here is not more to achieve the highest possible return. I am a high risk investor, very high. If you think you have high risk, my profile is probably even higher. I only invest in relatively smaller, more unknown, risky stocks. That could possibly go up tenfold, but it could also go down by 100%. And despite all that, I have the impression that America is still at a very high level, and the lessons from the past are always the same. When the valuations are sky high and the expectations are super high and optimistic, then it can only disappoint. Maybe not, we'll see. And no one knows exactly what the impact of all these decisions will be. Time will tell. My goal isn't really to achieve the highest possible return, and I prefer to invest in America. I just feel that way. The status I have now achieved with financial freedom, that took a long time. That's hard work, being patient, and also making mistakes. And I'm not going to lose that position anymore. So I prefer to invest with a potential that is a bit lower return and a bit more certainty than just going along with a hype. That might be the last phase of a bubble. I've shared several videos the last period, and that was all before the news. Also from DeepSeek, you only see a small news item. You can then have a very big reaction in the market when a lot of people do know. Yes, this could very well be the last phase of a bubble, but everyone still wants to grab that last bit. And watch out, there are multiple players. We are long-term investors, but in this market, there are also a lot of short-term traders. There are also a ton of algorithms, very large companies with billions of dollars that just let algorithms keep running. So that valuation can keep rising for a longer time. No one knows how long that will last. The opposite is also true, and that has happened before. If those algorithms are triggered to sell, then they trigger each other. And can the stock market drop very quickly? And we've already seen that this week, based on AI reports from China. In this update, I will first, of course, start, as usual, with the recent transactions from the past month. Then I'll show a number of stocks that are going to be insanely better than before. So that's good news. And maybe also a buying opportunity for this year. Want to see it? Let's first take a look at the transactions. Before we talk about the portfolio update from DEGIRO with the recent purchases I've made. First, about indirect brokers. I've explained this before. This is a business account, so this is business wealth. The reason is not specifically that it's better than private. Often private investing is better, especially if you are below a certain tax threshold due to taxes. But this has grown so much, and interest brokers is an account that still accepts business accounts, whereas in the Netherlands, not the case. Moreover, it's actually quite, relatively high interest saving on your cash assets. And in my case, that's favorable because I've kept relatively a lot of cash on this platform. And by the way, you can just follow all our monthly updates. We would really appreciate it if you could subscribe and like the video. That helps us grow in the YouTube algorithm. That way we naturally get more viewers. More money will yield more returns, and then we can invest more money in better quality content. For example, video editing and also just more research into stocks. That aside, always, your time is greatly appreciated. So I'm going to try to provide as much good information as possible. Speaking of that, we see the performance on a monthly level. And this month, my portfolio has performed significantly better than the S&P 500. It achieved a 2% return over the past month, and my stocks 8%. So that's a factor of 4. And on a monthly level, that's quite a lot better. The real estate funds, however, are performing a bit less well, but of course, a bit less price potential, but they do pay out dividends. The cash position is relatively large, and we can also see that reflected here in the allocations. So the cash position is relatively more than half. And what's striking is, and I want to share this with you because it's just fun, energy is quite a large portion of the portfolio. the industry and then the real estate funds, and only a very small percentage is invested in technology. That might seem a bit strange. I said I am a growth investor, and with the brokerage account, we also see, in a moment, I'll show that much riskier growth stocks. But this portfolio update is something different at Interactive Brokers. And the reason is I'm not in a hurry. I don't need to invest my money. That's very important. If you're a beginner investor, I think it's just better to start completely, to start investing and just keep doing it every month, buying additional ETFs or stocks, preferably at good valuations, because timing the market is really difficult. But I am already financially free and I've already explained what my goal is. I don't necessarily need to achieve the highest possible return, and I will achieve my goals because I still have more than 30 years to grow my wealth. With a market average return, that means millions in 30 years. So that's how simple reality is. So I don't need to take any risks. That's why it can only get better if the market still dropping. I'm not saying that the market is dropping, but if the market drops, then I'm in a good position with my cash position. This portfolio is also a bit more focused on dividend income, but that's just completely coincidental. I'm not a dividend investor. I prefer to invest in good companies that achieve a high return on equity and return on invested capital on their own equity. Because of that, I have to do less and can achieve a higher return. But anyway, there is a project here, projected income of 3,800, and translated to the portfolio, that's about 3% per year. We're seeing some poor performance, some good performance. And there, I will briefly show the holdings. First of all, I wouldn't recommend it because these are all not unique companies. Cycles, commodities, rare positions, maybe also for most people. There are a number of serial acquirers. That might also carry a bit more risk due to debt profiles. I've further developed a number of positions. And for example, there are the shipping stocks. Already in 2024, I made videos about shipping stocks. Looks very interesting. And for a long time, they have also performed very well. I always take Frontline as an example. I recently bought more Frontline. Let's see where Frontline is. And I've had Frontline in the plus for a longer time. So I took the first position somewhere in 2024. I don't remember exactly when. Let's take this peak. And plus 50%, you have been at for a long time. But you see, in a very short time, it has dropped by about 44%, even 50%. And I bought Frontline somewhere around here just after that huge drop. Well, that was a good move, but it was just a small percentage that I bought more of. Result, also with the DEGIRO portfolio, despite a very good return in 2024, it's still in the negative, minus 13%. But the total profit and loss is quite a bit less. And the same goes for DHT. That goal was also a bit in the plus. But the total loss is actually a profit of $470. And that has to do with the high dividend they pay out. And I still think that shipping stocks are quite attractive because of the valuations. And I've often explained what the investment thesis is for the long term. So I have quite a few shipping stocks, as you can see. And I actually consider this as a mini ETF. There are 5 or 6 or 7. I am on TVK. No, sorry, 10. And that's just a mini ETF in shipping stocks. High dividend. I think that in the long term, because there will be a shortage of ships, that it's going to be a booming business. But we will see more relevant. Actually, I think for the beginner investor, but also especially for the long-term investor, which I believe has potential opportunities, at least better opportunities, are KPG. And KPG, that stands for Kelly Partners Group. That's a creative crime company. And at the beginning of 2025, I made a video about the 7 best small cap stocks. KPG's performance since then has been very good. I can say that, but definitely for the long term, this is a very interesting stock. My current position has grown to 9,000, and the total return is 43%, I believe, in about a year's time. Less than a year's time, even. Definitely check out that video about small cap stocks for 2025 on our channel with all the information about Kelly Partners Group, but be careful, it's quite risky. They also have some debt that they use to make acquisitions. And in terms of market share, it's also a relatively small company of about, I think it's grown to around 400 million now. So not very, very big. And finally, a little update about real estate funds. For the first time in 10 years, I have invested in real estate funds. And the reason for that is, as I already said, situational. I think that the S&P 500 and especially the NASDAQ 100, the S&P 500 and the NASDAQ 100, relatively high valuations. And it could be that the expectations are really high. Only if expectations are really high, it can also drop quickly, just like that. And then a crash can happen very quickly. In relation to the S&P 500 with a price to earnings ratio of 27, I find that real estate funds currently have a more interesting profile, not just for the price return, but also because they pay out dividends. And once again, I'm not a dividend investor, but if you can make free money with a low chance of losing money, why not? You have price potential. Chance of losing money, yeah, then why not? And you also have price potential. So we've made videos about real estate funds before, so definitely follow our channel. Subscribe so you won't miss any updates about it. As usual, let's first take a look at the recent transactions from the past month. Now, despite a poor result today, yesterday the position of the portfolio was looking really good and was almost reaching 200,000. So that's kind of nice. Emphasizing nice because, to be honest, it doesn't really affect me that much anymore. They're just numbers. I would definitely lose sleep over it if I suddenly lost everything, but that's another story. But whether it's 200 or a million, it doesn't really matter that much anymore. Except, let's say, if I had a lot, then I would just really go low. Risk of investing. I just think passively in ETFs and mainly live off the dividends. But let's put that aside. The goal is to become financially free. Once you've achieved that, it's really just about doing what you enjoy. That's super important. The transactions from the past month have been additional purchases. Let's start the bottom. Let's go. So Frontline, I just talked about that in the update from Interactive Brokers. I also bought a little more Frontline in the DEGIRO portfolio. And then you see the price fire of 14.8. I've already shown that it had dropped a lot. So I bought more, almost at the dip of that decline. I sold one share of Booking Holdings out of the two. And just because the valuation had risen to a price to earnings ratio of 35. As I said, I need the money for other investments because I want to reduce my risk in America a bit. But I still have one share that I'm holding for the very long term. Unfortunately, I had to say goodbye to an ETF that I had for a long time, but just continues to perform poorly. And especially if Trump, everything continues his wish. I see not many opportunities at the moment for the ISIS Global Clean Energy. And in hindsight, this was a good choice because it has only gone down further since the sale. But hey, in essence, ETFs are, of course, long-term investments. So I'm not proud of it. Unfortunately, I had to sell Dispaga, 36% return in 9 months. Absolutely great. But why did I have to sell? Because Dispaga is being taken over by Process, an investment fund. I find unfortunately bad. Had a lot of potential. But other than that, I mostly bought more of Zeta Global Holdings at a price level of 16.9. Bought more Technion. Just a relatively small amount of 1,000. Because I bought more of the China ETF, I also got a more detailed update about it last week. So I'll share a bit more about that later. And for the first time, the China fund is in the plus. So that's nice to see. I bought more of Green Landscaping, which is a serial acquirer. Here again is the repetition that I mentioned. I'm increasingly investing in serial acquirers. I find that really interesting, and I just find it fun. But smaller percentages in multiple ones. Just some risk diversification. And yes, it's just that I enjoy it. Not to become the best investor in the world. I think that's an illusion, because you only really know that after 30 years, and then you have to invest full-time. And by full-time, I mean 80 hours a week. And yes, that's quite different. Landing Club, bought more of Landing Club, but a small percentage in the same power industry. Well, both Landing Club and power industry, actually in 3 days, it went up by over 20%. But because of the DeepSeek story, power industry has dropped a lot. Power industry in a nutshell is basically just building solutions. So control cabinets, electrical wiring and things like that. And of course, for the thesis, if OpenAI and such are going to build a lot of data centers, then the power industry, those kinds of companies are going to benefit a lot from it. So besides power industry, I also have a very long time. Celestica, I've had it in my portfolio, but I sold it because unfortunately, it has only gone up further, but I already had a lot. Return on Celestica was 200%. But anyway, that's beside the point. And Landing Club is just a small investment in a risky financial stock. Investment in a risky stock, financial stock. I bought more StoneCo and PagSeguro. The two names StoneCo and PagSeguro keep haunting me. It has been declining. While the prospects seemed super good, only the macroeconomics were really against it. But both StoneCo and PagSeguro are still buying back their own shares. Buying in, and I think, why shouldn't we believe in this? Both still have enormous, very large growth potential. Despite strong competition, they can still grow a lot. And the tease remains, if one of the two takes off, then the loss from the other will be more than compensated. Unfortunately, yes, sold ACM Research, and not specifically for the company. There have been some developments regarding this company because of Trump. This has a part of the production of ACM Research on a put on restriction list for import, but I sold because I just bought more of the China Internet ETF, and both are linked to China. But then I have my position in China. I would like to bring it back by selling an individual stock and reallocating that into an ETF, simply to reduce risk. But it's still an interesting stock, I must say. Bought more for the first time, Volati. Also a serial acquirer, and also S-Liptech, also a serial acquirer. Bought more of both from Scandinavia. And today I bought more of Evolution. Evolution keeps teasing me too. I don't get it. Great prospects. But today, based on earnings, it has dropped by about 8%. I have bought more again. I don't understand why it keeps dropping so much, but that must be my fault. My position has now grown to almost 30,000, because at least 4,000 plus 26,000. So about 30,000 in ban stock. The other largest stock is App Loving. I had set a stop loss order on App Loving at 305, but luckily it never hit that 3.05, taken for the short term, and it just keeps rising. So yeah, the only difference between App Loving and Evolutions is the valuation. For Evolution, it just keeps dropping. So my first position was taken here in July 2024, and I've continuously bought a little bit more. But the first initial position was at minus 22%. While the stock seemed to be bought at a reasonably good valuation, and it just keeps dropping, as you can see. The latest quarterly figures are actually quite good. Well, that's great. There are a few developments and your quarterly figures for years. I had to say 2024. They are online, and you can download them now. And you also see the CEO's comments about the whole story. Well, they just keep making acquisitions, and they also keep buying back their own shares. They have a larger share buyback program launched. They had already bought back shares, but they are still buying back even more shares of 500 million. It stated this, 500 million. The dividend is going up a little, but again, regarding the dividend, and we would rather see that money simply being reinvested in further growth. It's still just the story of Evolution that it's just in a very negative momentum. So anything that isn't going well leads to quite a significant decline. And I feel like I'm just buying more. That minus 15%, I definitely believe that it will turn out well in the long run. And if it shows a significant increase again, then I'll just take some out to reduce my risk. Just to show the difference also with Evolution. Look, that valuation has now simply dropped to a price to earnings ratio of around 14. And historically, the fair value line, that's the intrinsic value that the company could achieve, is still at a price to earnings ratio of 30, but that is due to high growth expectations. But because the expectations are being constantly adjusted downwards, and analysts still expect an average profit growth of about 10% per year, what strikes me very realistic seems to be for a great company, a scalable company like Evolution. Yes, that price to earnings ratio has dropped to 14. So even if the price to earnings ratio is 15 over the next 3 years and they achieve 10% profit growth per year, I see no reason why that wouldn't work. Can they still achieve an average return of 14%? So that's why I believe so much in this kind of high quality companies with super high profit margins, super earning model. Good management. I think efficient capital use is important. It's just that everything is going against us right now with all the bad news, and that just weighs too heavily. Teleperformance, nobody likes it. Company, but I do. The management isn't really superior. The company isn't really superior either. I have to say, for those model call centers, yeah, what the fuck. No one cares. And then you also have all that hype around AI. Of course, when human voices are replaced by artificial intelligence, then that's not good for Teleperformance's business. For example, I'm making this video in Dutch and then I'm translating it into English with an AI program, German, Swedish. Weird. And it just seems like I speak perfect English. Well, my English isn't great, but not bad. But with that program, it's really good. There are really remarkable developments in artificial intelligence, only Teleperformance. I feel like a lot of people still just want to talk to a person. Just think logically for a moment. What does the company do? And what is its business model? And I think artificial intelligence is an opportunity for Teleperformance. What's great about this company? It's not a great company. I don't find it to be superior either. Unique company. The profitability isn't really that great either. For example, the profit margin of 6.5% isn't great. Return on equity isn't superior either, although 50% is still good, but the return on total capital is quite low. But the valuation is also very low. So the stock and is bizarre. A lot has dropped. And even at the peak, where someone was willing to pay a price in 2021 from 380, people are now only willing to pay a price of about 90. And the drop was just minus 80%. I have taken the first position, Teleperformance, somewhere around the price level of 90. And then I bought in a few times at a price level of 100. And you're finally starting to see that it's actually a slight increase again. And I'm really curious if this is the beginning of a further increase. Looking at evolution, it has a price earnings ratio of 8. Yes, you don't need a lot of profit growth to be undervalued at a relatively low price earnings ratio. So it's actually very simple. If you want to make a return with investing, buy super expensive assets, but they do need to achieve some profit growth. Sometimes companies are just like Teleperformance, possible, maybe unjustly. So much has dropped that they are not only cheap, but they can also achieve profit growth. And we see that reflected in the bad luck ratio. And that bad luck ratio is below 1, even 5. And we see a price to cash flow of just 3.3. Bizarre. They have also made interesting acquisitions. I find Alphen, based on news from those acquisitions, the stock was further downgraded. But I find the acquisitions interesting, so we'll see. Time will tell. And the EPS growth is indeed expected in this database at about 10%. Yes, here, a price earnings of 40. You can clearly see in relation to the EPS growth, which is the profit per share, it is overvalued. And then it dropped hard and very much below the fair value line of price earnings equal to 15. You always need to zoom in a bit for a more current situation. And if we look at the forecasting, we see that the price earnings for next year, according to this model, is even a bit low at 6. So we don't know exactly what the difference is between a price earnings of 8 versus the 6 that we see here. But analysts, and there are 16 and 14 in total, expect on average 9% whole profit growth. I don't know why there are 16 analysts, which is relatively a lot, so let's just assume for convenience that it's correct. The price earnings is so low. A price earnings of 15 would just be normal for this type of company. Okay, let's assume that's the case. Then you have a total average return of 50%. While the company only needs to grow from a low valuation back to a normal valuation as long as they do achieve good profits. If things go wrong and artificial intelligence continues to be a setback, yes, then it really falls short. But even if they only have a price earnings of 10 over the next 3 years, you would still have a higher return. So there might not be much to lose with this stock. That might be the most important thing to mention. They also have a dividend of 4% per year, even a bit higher. By the way, the normal multiple was at 28. Very high. If they achieve a price earnings ratio of 20, then you have an average return of 67% per year. Yeah, no idea what that's going to do. I just think that an average of 10% per year is achievable. So another stock that I bought in the overall strategic shift from America to Europe, Alone. Alone is a relatively small, very small company now in the Netherlands. Alphen, the same story. A lot has dropped, and I have been following Alone for a long time, but I only bought it when it had dropped by about 50%. Here, based on the earnings reports, turns out it wasn't a super favorable entry point, but I bought a few more shares during this downward trend. By the way, the same goes for Teleperformance. So, if your initial entry point is not good, is it of course necessary? If you believe in the company, to keep buying more. And the first position in Teleperformance was taken in November, and then I bought more. The last time I bought more was December 17th, also something that was bought at a lower price. So I bought more twice at a lower price, which lowers your average purchase price. Yes, and when the stock starts to rise, then you have it faster, return, but you have to be right. If the company shouldn't go downhill or get worse, or a bit of the same story. Actually, I bought a bit too much after those initial drops. Yes, definitely. What I've definitely done right is keep buying more during further declines at lower prices. Yes, definitely. This is definitely high risk. This is a small company. You can now see a clear increase in momentum. And in the short term, the stock has really risen significantly, about 25% in a relatively short time of 1.5 months. I think it's already very interesting. Have I talked about that before? Told, finally, to wrap it up. Otherwise, I'll just keep rambling for another 2 hours. Is PagSeguro and StoneCo. Speaking of bad entry points. But buying the dip is important in this case. PagSeguro, bought for the first time in beginning 2024. And the stock keeps surprising me. It looks like very cheap settings, and the prospects seem really good. But the interest rates in Brazil have risen a lot. And because interest rates have risen much, it naturally has a negative impact on companies like PagSeguro. A long time ago, in 2021, the company was willing to pay 60 per share on the market, and that has now been done to about minus 90%. The first entry points were in 2024, and that is somewhere here during this period, because the momentum had increased significantly, and it looked good that it could take on an upward trend. But my message, and the initial position has dropped by 50%. So we see that here somewhere. So these initial positions had dropped by 50%, and that was all around the price level of 13.12. But what I've done is continuously bought more and not higher, larger amounts on that 1,000 euros there. Still, always just continuously smaller amounts. Yeah, maybe I should have waited. It had dropped to 6.7. Yes, right. But yeah, no one knows how long it will keep dropping. So that 6.5 that I bought, that was actually around this level here. So almost at the bottom, but it's really hard to know what the bottom is. And it seems now as if the momentum is starting to come back for the first time. So the stochastic is starting to drop, and the MACD is also starting to show a positive crossover. Then you can also see that the green bar here indicates that there is more momentum. So there are more buyers than sellers, to put it simply. And yes, that all happens to be around this same bottom level of around 6.5 roundabout. And the same goes for StoneCo. StoneCo has also dropped a lot. It's also just a potential stock. The management has just indicated that we're going to buy shares, buy more. PagSeguro Bureau Management is also buying shares. And also StoneCo is slowly starting to crawl back a little bit. But much more important is just the factor on the diesel was actually a strong buy when I bought it. And now it's a sell. So it just shows not to put too much trust in statistics and algorithms. Definitely, only when I bought, the valuation seemed okay to me. Only, yes, the macroeconomics are just against it. And the valuation has only gone down further. So the valuation was okay when I bought Alpha, and I thought for the long term, but in the short term, it has dropped by 50%. So yeah, who am I to argue with that? And the valuation has now dropped to a price of 6. And the loss ratio seems to be 0.4, which is super low. So yes, great. Well, the downside to PagSeguro is the negativity leverage cash flow that we see. So that's the possibility. So the net income is indeed positive 11%, but we see a leverage free cash flow margin of minus 60%, which is not positive. On the other hand, the return on capital has always been quite high for PagSeguro. So these seem to be just stocks that are just, if the macroeconomics improve a bit more and interest rate policies become a bit more relaxed and such, then they could really explode. Because finally, just a very brief update about the ETF. Crane Shares China ETF. I've made a separate video for this with an update on why I invested in this ETF. And the position has now grown to about 10% of the DEGIRO portfolio. And recently, I just bought more of the Crane shares ETF. So the first purchases of the ETF was after a significant drop in 2022. And then I bought more, at least bought more in 2023, 2024, and recently also in 2025. Bought more twice. And the end of 2024, and the amounts have actually just gotten bigger and bigger. And the performance is finally showing a slight gain, yes, of 1.3%. So it's starting to go in the right direction. And what I explained in the video about this ETF is that I believe that it's a good entry point to buy this ETF now. Strong companies, good earning models, but it's in China, so there's a bit more uncertainty. I invested 10%, and I'm really curious to see how it will go. A bit about the ETF very briefly. Thanks for watching, and I would say see you at the next portfolio update.